Welcome everyone to Vested Interest. This is Shane, and in this video, we're going to cover our weekly portfolio update. We did add $738 and some change in new capital to the portfolio, so we will cover what we bought with those funds, any options I was in, any dividends received. That is what we do every week on this channel. We'll also see my full portfolio towards the end of the video. I think it's important for those of us in this space to show the people who are watching our real portfolios built out over time, so you can see we're not just talking about this stuff, we are actually doing it. So that's what I do on this channel. And right into options. We did have a little bit better options contracts luck this week. Two different contracts. We had $38.41 in total options premium received, and we received those funds from a couple different contracts. First up, both of these are covered calls. We've got a -2, which represents 200 shares. So to do a covered call, you have to own 100 shares or more of the position that you want to run covered calls on. You could do also cash secured puts, which means you have to have the cash to buy the shares. But in this case, both of these are covered calls. So again, first up, 2 covered calls, right? One contract with 200 shares for AT&T, ticker T. This is out of the communications sector. And that strike price was $29.50. That basically means by August 29th, we opened these on August 25th, so that was Monday. So by August 29th, on Friday, if the share price was $29.50 or higher, then these shares would be called away. You can see we kept these. They expired out of the money, so that means we kept the shares. It was not above $29.50, and we received $10 in options premium to run this contract, which amounted to, after fees, $18.94. And then the next one up, right, was another sold to open covered call, and I sell calls, I do not buy calls. And again, -1 represents 100 shares, so that's just 100 shares of Kroger, ticker KR, out of the consumer staples sector. And same thing, we started that contract on April 25th, which was Monday. Strike price is $72, so again, it would have to be $72 or higher for the position to be called away with an expiration date of August 29th, which was Friday. And for that one, we received 20 cents, and then after per share, and then after fees, $19.47. That's where the $38.41 total comes from. And then again, as you can see, they both expired out of the money. That just means we keep the shares of AT&T, we keep the options premium, and we look to possibly run that same thing again next week. Now, I usually put out 4 or 5 different contracts. These are the 2 that hit. And some weeks we don't get any that hit. Some weeks we get like this one too. Last week I think we got 1. So that's the thing about contracts, options contracts. You have the person writing them, which in this case is me, and then you have to have a buyer on the other end, right? So the seller is me, the buyer is whoever bought these on the other end. That means someone on the other end was willing to pay $29.50 per share for AT&T and was willing to pay $72 per share for Kroger and wanted 100 shares of Kroger and 200 shares of AT&T. Next up, dividends. Not as good on dividends this week. Nothing to account for here, and it seems that's the way it's been going. We'll get dividends some weeks and not get options, and then other weeks we get options and no dividends. Hopefully we get a week here coming up where we get both, but no dividends to really talk about this week, so we'll jump through that. On to the first new income into the portfolio on August 25th, same day we ran those options contract. We went in and added $339.44 in new capital to the portfolio. With those funds, we picked up 2 shares of Vale, ticker VALE. This is a mining company out of the material sector. This is also a foreign company out of Brazil. So there are some tax implications around companies like this whenever they pay dividends. If they are foreign companies and they pay dividends, you will either be responsible for the dividends, or in my case, my brokerage account takes those taxes out right away, so I don't have to worry about it. So you just want to understand that some of these foreign companies, if they pay dividends, there are tax implications around them and how those taxes are handled. Talk to your tax advisor, your CPA if you have one, so that you understand what you're doing with those. But 2 shares of Vale, picked up those shares at $10.20 per share. Picked up 1 share of Pfizer, ticker PFE. This is out of the healthcare sector. Picked up that 1 share at $25.26. 4 more shares to our Comcast Corporation position, ticker CMCSA. This is out of the communications sector. Picked up those 4 shares at $34 per share. 1 more share to our Procter & Gamble position, ticker PG. Been nibbling on this one, doing about a share a week here for a while. I want to do this for at least another week. I'm almost to 100 shares. I'd like to get this to 100 shares, maybe slightly over, if it stays under that one, or right around that 155 and under range. 160 and under, I'd be willing to pay for this, but not much more than that. Picked up that one share at $157.80. This $339.44, the new shares picked up with the funds added an additional $12.72 in passive income over the next calendar year. I went back into the portfolio on August 29th, which was Friday, added an additional $398.59. And with those funds, we added Schwab Strategic Dividend Growth ETF, 2 shares there. This is part of our weekly buys, ticker SCHD. This is an ETF, Dividend Growth ETF here. Picked up those 2 shares at $27.88, and we're buying at least 1 share of SCHD, if not 3 or more of SCHD every single week, regardless of what the market is. I'm going to continue to add to this one at least through the end of the year, and then we'll kind of see where we're at, maybe switch up to another ETF or maybe continue to build it out. We'll see. Then added 1 more share to our Pfizer position, ticker PFE, out of the healthcare sector. That 1 share picked up at $24.80. And this is other one part of our weekly buys, ticker VTI. This is Vanguard's total stock market ETF. That is all of the companies covered by the United States stock market here. So we added 1 share there at $318.04. And again, I pick this up every single week, at least 1 share of VTI. If this was to pull back below my cost basis, maybe I'd get 2 or 3. But right now, it seems like it's setting a new all-time high every single week. But we're going to continue to buy. That's part of dollar cost averaging, regardless of what the market is. On Fridays, I'm going to pick up at least 1 share of SCHD, and usually 3 or more, and at least 1 share of VTI. Now, the $398.59 in new capital, the shares I picked up with it, added an additional $7.45 in passive income over the next calendar year. Total invested $738.03, which added, and the shares that it picked up, which added $20.17 in additional passive income over the next calendar year. Quick run through the sector weight update here. Communications makes up 10% of the portfolio. Consumer discretionary at 3.21%. Consumer staples makes up 8.47% of the pie. Energy is at 9.85%. Financial is sitting at 6.64%. Healthcare is still the largest piece of the pie here at 16.84%. Industrials makes up 6.24%. Technology is still in second place slightly at 13.7%. Materials makes up 2.31%. Utilities sitting at 3.54%. REITs and real estate sitting at 5.99%. And ETFs is in third place. Eventually, this will be the largest piece of the pie here, just by the nature of picking up that 1 share of VTI and those shares of SCHD every single week. And it sits at 13.22% of the portfolio. Over here on the right, you can see those same percentages there that match the pie on the left, as well as the dollar amount allocated to each sector as well. All right, here it is, the total portfolio, a snapshot of the portfolio. I did the update on Saturday morning. So yesterday, this is, as of yesterday, all of this was updated, and I show this every single week. Again, as I mentioned in the beginning, I think it's important for those of us in this space and talking about finances, talking about portfolios and investing, to show you what we were actually doing so you can see a real portfolio built out over time. The ups and downs of a portfolio, the ups and downs of holding individual positions, as well as the ETFs that I hold in my portfolio. Maybe some other people have some different ETFs, some different positions, but it's going to be very similar. You're going to have times where the positions are up. You're going to have times where they pull back. Each position has a 52-week high and a 52-week low, and those positions can retest or reset that 52-week high and that 52-week low a number of times throughout the year, and for a number of different reasons. It could be around earnings, whenever they have good or bad earnings reports, growing or decreasing their top and bottom lines. Could be around negative news or positive news. Could be around things like war starting, or in the case of the energy sector, sometimes it's around bad storms that might shut down production for a little while, especially oil and gas, right? We've got oil and gas rigs on our coasts out in the oceans, and sometimes if there's a bad storm and they have to shut down out in the ocean because of it, or if they have to shut down on the land because of it, they might impact oil and gas prices. That's just the nature, again, of owning individual stocks. They go up and down and can retest and reset those 52-week lows and those 52-week highs. I try to buy whenever stocks are closer to their 52-week high. That's what this column over here is, 15% of a 52-week low. So I'm looking for a lot of my positions. I want to be buying whenever they're dropping, and I want to be holding whenever they're running up. Same thing whenever I'm adding a new position. I'm looking to get into those new positions as cheap as possible, sometimes even running cash secured puts on them to get them a little bit cheaper. If you want to buy a position and you have enough to buy 100 shares, a cash secured put at a price that you're willing to pay, is not a bad way to do it so that you can get it a little bit cheaper than what you would be paying otherwise, and also get paid to wait on that position to drop into your buy price. Nothing wrong with that. All right, and hopefully this helps out some of you maybe who have just started investing to see that there are ups and downs, right? Comcast, I'm still down 11.72%. I'm still buying that position. That means I'm bringing down my cost basis, bringing up my yield on cost and my dividend yield, and bringing up my potential future returns, right? Just because a position goes down does not mean it's a bad position unless the fundamentals of the company have changed, right? I don't think anything's changed with Comcast. So if I was willing to pay $38.48 per share, I should be willing to buy more at $33.97 per share. It's cheaper, right? Whenever you go into a store and you see a sale, you don't not buy the item you are going to buy. If you're going into a store thinking you're going to pay $90 for a pair of shoes or $120 for a pair of shoes or whatever it is, and you walk into the store and there's a sale on those shoes and you can get them for $60, does that mean you're not going to buy them because they're cheaper? Oh my God, they're terrible shoes now because they're cheaper. No, you'll gladly pay the $60 sale price and probably pick up maybe another pair of shoes or some socks to go with it and move along, right? The stock market seems to be the only market, and that's what it is a market of stocks, just like your grocery store is a market of different types of groceries, right? This seems to be the only market, the stock market seems to be the only market where people see a sale where things go negative or turn red and they run away. They want to sell. Oh my God, it's a terrible position. It just doesn't make sense to me. No, it just means it's cheaper. And actually, if you get it cheaper, that decreases your risk, right? The cheaper you buy something, the lower the price to earnings it is, typically the less risk there is with that position, right? Again, unless there's something wrong with the fundamentals of the company, their revenues are collapsing, their margins are collapsing, their overall product is not selling, something like that. If there's something wrong with the fundamental, they're in a lot of debt, that they can't cover. If there's something wrong with the fundamentals, obviously that's a different reason. But if they're just dropping on negative news, or maybe they had one bad earnings report or something like that, those are the times to be looking for those distressed companies where they're maybe out of favor. Maybe the tech sector is really running up, so consumer staples and consumer discretionary and healthcare is not. There are different sectors, and at different times of the market cycles, different sectors will do better than others, right? So in my opinion, our job as investors is to find those positions, those sectors that are out of favor and be buying them whenever they are out of favor and they're cheap, or whenever there's that negative news like UNH. That's why we bought UNH whenever there's a lot of negative news around that one, and it's up 13.14% right now. So I think my strategy works over time, but sometimes there is going to be time where it doesn't, like for Comcast, look really good and you're going to have positions that are in the red. It happens. All right, going to get down off my soapbox here and run through this. In this column, all the different positions in the portfolio, total shares, and then again, I updated this on Saturday morning, so this will all be as of yesterday. Current price of each position here, market value here, my average cost per share, my purchase price here. These do include reinvested dividends. So that's money I purchased the price plus the dividends that have been paid out and bought more shares. That's all included here in the average cost per share and the average share price. Total return, whether I'm up or down, you're going to see it. Percent return, same thing. Obviously, the ones that are in red are negative, and the ones that are in green are positive, and the darker the green, the more positive they are. Currently, biggest winners AT&T at 68.92% and Kroger at 49.82%. But we've got OHI at 44%. I mean, we've got quite a few positions. Google up 35%. If you remember, I was buying this several months back here in the 150s earlier in the year, down in the 150s. It's really run up down in the $212 range, over $200 again. So Lam Research, same thing. I was buying this way back the beginning of the year in the $60, $70 range. This one has really run up 37.23%. So my strategy seems to be working over time. I've had this portfolio for almost 5 years now. So I'm going to continue with my strategy and keep doing what I'm doing. Which sector each position falls in, whether they're quarterly, monthly, semi-annual payer. We don't have any monthly payers right now. We used to own Realty Income, which was a monthly payer. I may get rid of this column if I don't get one here shortly, or just leave it there blank. And then you can see the yellow highlights. These are all the positions that have already raised their dividend for the year, right? We're still waiting on a couple. Lennar hasn't raised their dividend yet, or at least announced one yet. Lam Research, haven't seen that one yet. I think that one usually is in September, so hoping for that one coming up this next month. OHI, it has not raised its dividend in several years. I'd love for them to get back on it, but I locked in such a high yield on cost at 9.12%. I'm not as concerned with that one. Plus, I'm up 44%. So, very high yielder with some price appreciation growth. So, really like that position, even if it's not raising its dividend. Haven't seen one on AT&T. I bought this one knowing they had recently cut their dividends. So, for now, I'm good with it, but I would like to see them over the next couple of years raise their dividend. If we're 2 years from now talking about them not raising their dividend, maybe we look to trim that position. And the other one is Vici. Haven't seen that one yet, or Verizon. Excuse me. Current yield of the overall portfolio here, my yield on cost here, portfolio weighting. So each individual position's weighting here. And I do have a rule in my portfolio. I do not want any one position to be more than 10% of the portfolio. And I do not want any sector to be more than 20 to 25% of the portfolio. Now, we're not very close on any of them. Google is one of the highest at 7.11% of the portfolio, and that's because it's run back up over 200. And that rule does not apply to VTI or SCHD. Again, these will eventually be two of the largest positions in the portfolio, probably over 10%, just by the nature of adding to them every single week. And still only puts SCHD at 6.16% and VTI at 7.06%. Estimated annual income in this column, dividend growth year over year here of each individual position, as well as the total at the bottom. Payout months here, and I do understand sometimes that these positions, especially positions that pay out towards the end of a month, they might slip from one month to the other. That does happen from time to time, but this is the typical months that they pay out. And where the company sits at the price at 15% of a 52-week low. Now, I use this price here in this column, and I do adjust this, not every week typically, but every couple of weeks, every 3 weeks. I try to go back in and adjust where it sits at 15% of a 52-week low. I use this column to keep my average cost per share. I'd like my average cost per share to be under this 15% of a 52-week low, right? So basically what that means, let's look at Chubb here, ticker CB out of the financial sector. My cost price, average cost per share is $266.65. Close of business on Friday, it was at $275.07, which is obviously above my cost basis. Now, I could continue to buy Chubb here so long as it's under $289.98. Even if the price went above $289.98, so long as my average cost per share was not above $289.98, then I could continue to add to this position, right? Hopefully that makes sense. Total shares, 6,924.627 shares. Market value of the portfolio currently $414,420.75. My cost out of pocket, including reinvested dividends, right, is $361,248.72. I am up $53,172.03 or 14.72%. I do not focus on this. I say this every week, and I'll continue to say it every week. I understand some people will tell you the only thing that matters is total return. I love to look at total return, don't get me wrong. It's great to see that I'm up in total return, don't get me wrong. But unless I sell all these different positions, I do not lock in this gain, right? I do not plan on selling all of my positions to lock in the gain. So total return to me, though it's nice to see, is not the most important part of my dividend growth investing portfolio. Because again, unless I sell out of all these positions, I do not lock in the total return. Now, the salary of the portfolio currently per month is $1,075.55. Per week, $248.20. Per day, $35.36. And per hour, 8,760 hours of the year, $1.47. Current yield of the portfolio is 3.114. My yield on cost, 3.573. And this is what I'm focused on. That's why it's circled over here in red. It is the dividends that eventually I will turn off the drip and live off of the dividends provided by the portfolio. And it continues to go up week over week, month over month, quarter over quarter, year over year as I add new capital, as the positions in the portfolio pay out dividends and those dividends get reinvested, as they raise their dividends. And it currently sits at $12,906.57. Should hit over that 13,000 mark by the end of September. And dividend growth year over year is at 6.02%. So if I was to stop investing in the portfolio, this right here, estimated annual income, should unless they adjust their dividend growth payouts, should grow by about 6.02% on its own year over year, which is above the inflation rate, which is what I want, about twice what inflation is on typical years. All right, that's really it for this one. I really hope everything is going well in your portfolio. Again, I feel like overall market is hitting new all-time highs every other day or every other week now. So it's harder and harder. As you can see there were only 3 positions in the red in my portfolio, so not as many to choose from as far as dividends that are in the red. I will have a video coming out here probably tomorrow of the positions I am looking to add in the month of September, because we are last day of August here. And I hope you're having a great holiday weekend, spending some time here in the last holiday weekend for the summer with some family and friends. I'm just hanging out with the family here at the house this weekend. We're getting ready for school. My kids start back to school on Tuesday. For those of you out there who have kids, maybe your kids have already started back. I know some other schools have already started or have been back for a week or two. So let me know how your portfolio is doing down in the comment section. Did you add anything this week? What are you looking to buy? Did you sell? I see some videos out there that people are starting to lock in gains, starting to think maybe we're at the top of the market. And September typically is a downturn in the overall market for whatever reason. Typical years is September is one of the worst months for the markets. We'll see how it goes. Sometimes that trend doesn't always stand, but typically September is one of the worst months for the overall market. So I'm seeing some videos now with some people locking in gains. Are you locking in gains on any positions? What positions are you looking to lock in those gains and sell some shares? Would love to hear from you in the comment section down below. And again, have a very happy and safe holiday weekend. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Let me know what's going on in your portfolio. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off with some peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in on this holiday weekend. And we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or see the advice counsel of a certified financial advisor. For those of you who watch to the end, watch time is one of the metrics that the YouTube algorithm looks at, so I really do appreciate that. And don't forget to share this with anyone that you think that might find value in the content, and hit all of those buttons down below. Really do appreciate it.